Hello and welcome to Passive Pulse series, where we discuss passive funds and ETFs. Equity markets are witnessing correction, sparking concerns among investors. In this session, we'll explore how to navigate these uncertain times, manage risks effectively, and position portfolios for long-term resilience. So let's begin the journey into the world of passive investing only with passive funds. And today's topic is market corrections and passive investing. And joining me now is Mr. Arun Sundaresan. He's head ETF Nippon India Mutual Fund. Welcome to the show, Mr. Sudaresan.
Thank you very much for having me on the show, Gitu.
Always a pleasure, sir. So we all know the markets are correcting, and how can staying invested during market downturns potentially help investors in long run?
The market corrections are part and parcel of investing. So if you look at the market data for any period of time, for a longer period of time, a good market, a bull market could be followed by a bear market. Sometimes it could be a little shorter, sometimes it could be a little longer. So investors will have to take them in their stride, possibly look beyond them and stay focused on their investment goal and not necessarily look at what is happening right now. My portfolio is negative, return is low, and get disheartened. That's not the best way to go about investing. They need to have patience, they need to have this understanding and wait out for good times to happen, to possibly relook at their portfolio, and if they're looking to redeem, possibly do at those points in time.
So in this digital world, everybody has access to their mutual fund portfolios on a click of a button. And whenever in every day nowadays that we are in corrective modes, every person, every investor usually looks and goes through his mutual fund portfolio and is concerned about the portfolio valuations. So why should investors continue SIPs in index funds and ETFs during a correction?
So not only SIPs and index funds or ETFs, in general in mutual fund, the concept of SIP itself is that you keep investing a fixed amount, a small amount over a period of time. Therefore, you're not subject to a market condition at a point in time. You're investing in good markets, you're investing in down markets. That helps you average out cost for a longer period of time. When you look at any portfolio, whether you made it in a lump sum mode or the systematic mode, when you look at a portfolio at a point in time when market is going through a sharp correction, then there could be a possibility that returns could look low and therefore you could be disheartened. But that's not how it is. These things keep happening, but you need to have that confidence, patience to hold on for longer and make your portfolio work for you in the longer period of time.
How do passive funds react differently compared to the actively managed fund in the bear market? Because we all know that rebalancing happens once in 6 months for passive funds.
Depends on the strategy. Some strategies, it could be once in 3 months, once in 6 months. Some even do once in a year. So that is one part. But passive by definition will be 100% invested. So if you talk about a Nifty index fund, it will be 100% invested in Nifty. And to that extent, if the market undergoes a correction, Nifty undergoes a correction, this fund also will fall to that extent. Also, including your expense, it could be falling a little more. Active fund, on the other hand, potentially could take cash calls. So instead of 100% being invested, it could invest little less. A fund manager could take different calls that let me invest into defensive sectors, so on and so forth. Theoretically, in a falling market, between a 100% invested portfolio to a portfolio which has a little more cash and taking defensive position could outperform, right? So therefore, this can happen. But having said that, over a period of time, there are a lot of data to suggest. See, anytime you take an active call, right? As much there is a possibility of you getting it right and creating alpha through those calls, you could be wrong as well. So that's a risk in trying to be very active in terms of taking cash calls, taking different sector and stuff like that from time to time. So it can work both ways. But passive, on the other hand, you get exactly what you signed up for. Like if you signed up for a Nifty fund, you get that exposure. You want aggressive portfolios, mid cap, small cap. Likewise, there are variations. Now, the way you can use passives in your portfolio, if you want to be defensive, for example, you could choose relatively defensive themes. For example, consumption would be relatively defensive when compared to infrastructure. It could hold you better. Some sectors could be relatively more defensive than others. And of course, instead of 100% being in equity, you could have fixed income as well, some bit of gold. So those are ways in which you can control your portfolio, you can mitigate the risk, but otherwise these are fully invested products. So from that sense, you don't get any downside protection.
How can investors manage emotions like fear and panic? Whenever there's a correction in the market, we usually see panic from the retail investors. But the history suggests that if we are disciplined investors, we are really going to make good returns and be on the beneficial side in the long run. How does history, see all this, and any examples that you can provide to our investors in this matter? Like if you are disciplined, if you stay invested for long, you're certainly going to benefit.
Yeah, so there are several instances, as I said, no one would have forgotten COVID even now, those 5 years now. So at that point in time, it looked like the world was coming to an end. So everything that could potentially go wrong, everything came to a standstill. Forget about your investment, it was falling so much. But if somebody had panicked and redeemed at that point in time, they would have incurred real big losses. But on the other hand, someone who held on to it, someone who actually made investments at that point in time, eventually gained significantly. All of us know, what happened. Likewise, there are several occasions in the past. Like, for example, take 2013. 2013, on hindsight, was a very bad year for India, where we had higher fiscal deficit, current account deficit, inflation was very high. India was on the verge of being downgraded possibly. So these sentiments were very, very poor. But the very next year, 2014, turned out to be a brilliant year. In fact, at that point in time, we had a huge bull run in just about a year when things looked very, very bad. So these things keep on happening. I can give you several instances. Therefore, one should not be driven by greed and fear. One should be focused on their investment goals and have the appetite to stay put during difficult times, and also to be kind of slightly mindful when things are exuberant. All these things will help investors in the long term. But on the other hand, if you're going to react to everything that is happening in the market, then you may end up losing.
So is it right to be loss averse in the sense that when the markets are up, we all are happy? When the markets correct, we all become sad and becomes loss averse. Like, now if we are invested, we want to get out of it and panic. What is the kind of discipline one needs to follow?
So again, the same point of greed and fear. So it's the behavioral analysis or behavioral gap, they say. So everybody talks about market returns being very good in the long term, like this much percentage return and that and this. But when you actually look at investor portfolio, the returns could be lower. And that could be because of frequent decisions like driven by greed and fear, that when markets are high, they invest more and more, and when markets take a big correction, they panic and they end up redeeming. So that hurts the portfolio. Eventually, their actual return would be much, much lower than the market return. So investors need to understand that this is the nature of the market, that you will have phases where markets will do well, it will not do well. So you need to be committed to your investment goals for the longer term. And especially, that's why we keep saying that investors, especially in equity, needs to have a long-term time horizon. Although no one says what that long-term time horizon, but the basis of that is you need to have the appetite, the wherewithal to hold on to your nerves, to your investment when markets are actually going through a correction. In fact, if you can make more investments, nothing like it. But so these things will have to be kept in mind. But on the contrary, if you react to markets, your experience and your actual returns could be much different from what markets are actually providing.
Mr. Sundaresan, thank you so much for being with us. It was a pleasure speaking with you, sir.
An investor education and awareness initiative of Nippon India Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.